Welcome to our video presentation for the CNPP, which stands for Community Navigator Pilot Program under USPACC, which also stands for US Pan Asian American Chamber of Commerce. My name is Dame Gorea. I'm here with Raquel. We work at Roth & Co. And Raquel will be the main spokesperson explaining all the main points of our presentation about business tax preparation.
Hi, this is Raquel, and as Dana mentioned, we will be covering some of these topics for our presentation for the business tax return. First off, it's the employer identification number, which is called the EIN. And then we will go on to the record keeping requirements for tax purposes. We'll cover basic bookkeeping and accounting methods, type of business organizations, and the business tax return. Employer identification number, EIN. Why is that important? The EIN is the number that is assigned to most businesses. You get the EIN number from the IRS. They assigned it to you. You can apply through the www.irs.gov. And the EIN usually is important because you need to put that number when you file your tax return. It's normally 9 digits long. So the fastest way to get it is online. The EIN is the permanent federal identification number for your business. So it's really very important that you have to get that number. The next topic we cover is the record keeping. As a business owner, you must keep receipts, sales slips, invoices, records for cash receipts and expenditures, bank deposit slips, canceled checks, and other documents that will substantiate your items of income, deductions, and credits. Although it may sound like it's a lot of work, unless you have records showing the source of your receipts, you may not be able to prove that some are non-business or are taxable. Bookkeeping system is single entry or double entry. For the single entry, that's the simplest way to record your daily and monthly summary of business income and monthly expenses. The system focuses on businesses' profit and loss statement and not on its balance sheet. Balance sheet is like a statement of your assets and liabilities. Normally, that will be your accountants or your financial person that will be recording all your transactions. So the double entry system is more complex because it has built-in checks and balances. And it is more accurate than the single entry method. Most businesses use the double entry method, bookkeeping. The next topic is the accounting methods. Accounting methods talks about if it's cash accounting or accrual accounting. For the cash accounting, that means that you record all your income when you receive it, and you record expense only when you pay it. For the accrual accounting, you record income when you earn it, even though you have not received the payment, but once you earn it, then you have to record it as an income. For the expenses, it's the same thing. So when you incur the expenses, you have to record that as an expense, even if you have not paid it. So normally you will have an accounts payable in your books. And the same thing on the income, even if you have not received it, then you will have an accounts receivable. What are the types of business structures? So the business structures are either you have a sole proprietorship, a partnership, a corporation, or an S corporation. Sole proprietorship is the simplest type of business organization. It's normally owned by one person, and that the business does not exist apart from its owner. As a sole proprietor, you will have to file the taxes under the Schedule C, which is the net profit from loss, and then Schedule C is included with your individual tax return, and it's reported under that 1040. The sole proprietor also files a Schedule SE, which is called the self-employment tax. Any income or losses that's reported in there will be subject to self-employment tax. The partnership is owned by two or more persons. A partnership is a relationship between two or more persons who come together to carry out a business. So each person contributes money or property or labor or skills, and each one expects to share both in the profit or the losses of the business. So the profit or loss of the business is usually reported in the K1, and in turn it's passed through to the individual, and they report it in their tax return. So a K1 is just like a W2, that source of your income from your wages, but K1 is your source of income from your partnership. Corporation. The third type of the business organization is the corporation. Corporations are treated by law as a legal entity. The corporation has a life separate from its owners and has the rights and duties of its own. The owners of the corporation are known as stockholders or shareholders. The corporation is taxed by itself. It's not a pass-through entity. They are taxed normally at 21%. You pay the taxes. For the S corporation, S corporations is a small business corporation whose shareholders elect to report corporate profits or losses on the same manner as that of a partnership. Like a partnership, S corporations do not pay tax. They are passed through to the individual's tax return and reported under their 1040, under K1. For the business tax return, we are here we put together the different types of business tax returns. The different types of business tax returns, we already talked about, right? 1040, the 1065, the 1120. And here's some samples of the tax forms. The 1040, as you can see, Schedule C, that's for sole proprietorship. So that's reported under the 1040 Schedule C, profit or loss from business. For that 1065 form, that's for the U.S. return of partnership income. That's a separate form that is filed. And normally that would also give you the K1 that will be reported and passed through to your 1040. Other forms are like 1120 for corporations or 1120S. We also have a list of documents that we will need when we start the preparation for the tax return. Number one is the financial statement. And normally the financial statement should already have been adjusted and all the entries had been made for the year-end adjustments. So it will be like a final amount that will be reported in your tax return. So with that also, we need the year-end bank reconciliation. So just make sure that the reported cash balance at the end of the year would match or would equal to the bank statement at the end of the year. There's also the annual and quarterly payroll reports are needed because you have to match your wage or salary that has been reported in your financial statement that would equal to what is reported in your payroll that was reported to the IRS or to the what do you call it? Social Security. So normally we refer to the W3 or to the W2 for the individuals or the W2 for salaries of officers and also of all the employees. So also the Form 1099, those are the forms that are issued or to all the contractors. So you can tie that into the amount that you have reported on your profit and loss for amounts that you pay to your contracted laborers, to professionals, to rent. And these forms are required to be filed to the IRS. And the due dates for this are normally January 31, like the W-2s. We also need the fixed asset list and the depreciation because we want to tie in those fixed assets and make sure that the depreciation are also entered into the fixed assets are entered in the tax return and that the corresponding depreciation are also reported in the tax return. So these are some of the information that we need. Sometimes they're not available because if you don't have loans or other payables, you don't need that. For the schedule and type of income, we just want to know whether that income is coming from, for example, if you own a home health, you will have like income coming from Medicare or coming from private insurances and all that. So accounts receivable normally is used for the cash method. When you file your tax return using the cash, the accrual method, in the balance sheet, we normally report the amount of the accounts receivable. So the inventory report is also needed because that's the basis also for reporting your cost of sales.
So next is we're gonna talk about tax deductible. So the main questions here, what are taxes deductible and what are not tax deductible? Generally, you may not deduct expenses related to rent, purchases, maintenance, and repair of a personal residence. However, if you use portion of this, your home for business, then you may be able to take a home office deduction if you meet the certain requirements. Deductible expense might include the business portion of real estate taxes, some mortgage interest, rent, utility, some insurance, depreciation of your asset, painting, and repairs. Those who work out their homes are entitled to deduct ordinary and necessary expense related to the business. Those are tax deductibles. This might includes related to regular and exclusive business use that can clearly distinguish from personal use or reasonably allocated between the two. Exclusive use means a specific area of your home is used only trade or business. It's very, very important. Regular, and that's important because both condition must apply. Also, if you work as someone's employee, you can claim this deduction only if the regular and exclusive business use of the home is for your employee's convenience, not yours, and it does not rent the business portion of your home. Here are just a few criteria that you would not meet when considering a business deduction for using part of your home. You use part of your home exclusively and regularly as your principal place of business. You meet or deal with patients, clients, or customers there. They're like tax deductible. Is pretty much a whole kind of it's a lot. And this videos, there's the URL, the website in the PowerPoint will give you much more details towards this. But we're only gonna talk about the business sections of what are and what is not the tax deductible. And next is we're gonna talk about taxable income for business. So we're just gonna ask like what type of payments that are taxable income for a business. There are traditionally forms such as cash, tax, credit cards for products sold or services rendered. Um, in addition, if you receive a payment that would not have been made if you didn't have a business, that payment is business income. Business can include like bartering, um, some real estate rents, interest and dividends, cancel debt, damages, or even kickbacks. Also, if you direct payment to a third party, it is still your income. It must be reported on your return, tax return. But there are business deductions too. You can deduct business expenses, the cost of carrying on a trade or business, but there are several types of deductible business expenses. And moving on,
We listed down all the key filing dates for 2023. And if you can see, January 13 is the IRS free file opens. January 17 is the due date for the filing for tax year 2022. For those that are paying fourth quarter estimated tax payments. 23 January is IRS begins the 2023 tax season and starts accepting and processing individual 2022 tax returns. January 27 for the Earned Income Tax Credit Awareness Day. March 15, that's very important. That's the taxes are due for some business types, partnerships, the multi-member LLCs, and S corps. Those are the form 1065, 1120S. If the tax returns are not filed, say you did not meet that March 15, extensions need to be filed. So the due date for, normally it will be like 6 months from the due date of the tax return. So October 16 will be the due date to file for those requesting an extension under 2022 tax returns. But if there are some taxes due, that needs to be paid as well on the due date, March 15. Otherwise, there will be penalties. So that's very important to keep in mind. April 18 is the tax day. unless extended due to local state holidays. So the C Corps are due on April 18. That's the Form 1120. And the 1040, that is our individual tax return, that is due on April 18. The reason for the March 15 deadline that we need to file for the LLCs and S Corps 1065 is because they will be issuing the K1 that will be needed for filing when you file your 1040. So 1040 is filed at the later date. The due date is April 18th. So these are some of the key dates that we can, that we want to share with you. If you can also go to the IRS.gov website, and we have listed it down for the tax filing season. So you can also check with your local state. Some states might have a different deadlines because they, it was probably changed because for especially those that were affected with some hurricanes, something like that. So they will have a different tax filing dates.
And if you guys have any questions, feel free to email us or contact. The contact information and our email is in the slides. And our company name is Roth & Co. And feel free to go to our website, rothcocpa.com. And that concludes our presentation for the webinar for CNPP. And thank you guys for watching. Have a good day.
Thank you.